Hello, welcome back to Lipper's Fund Flows Insight Report. I'm Jeff Turnhoy. For the week ended September 9th, 2015, the conventional mutual funds industry saw widespread, though not significant, outflows. Let's take a look at our macro groups and see where the bloodletting occurred. Equity mutual funds started the week with $2.5 billion in outflows. Taxable bond funds, not a whole lot better, $1 billion in outflows from them. Municipal debt funds struggled to get their way back into positive territory but fell short, $125 million out of them. And money market funds were the week's weakest outflow target, $11.8 billion pulled from them. Well, we're a couple of weeks removed from the extreme volatility that saw investors running for cover as the Dow Jones plunged almost $1,000 to begin one day and ended up down quite a bit after that. But for that week, it was an extreme amount of volatility that investors hadn't been accustomed to in quite some time. So no surprise then that we saw outflows, but this is a couple weeks removed now, and volatility has quieted down a lot since then. So I suspect that advisors may be telling their customers, finally, that maybe we should plan for another bout of volatility ahead, or at least they're preparing for what happened 2 weeks ago. So let's take a look at equity funds and see how they did. So again, still haunted by that volatility. It was actually a decent week for performance, but we saw domestic equity funds with $1.6 billion in outflows. No surprise there. They've been in outflow mode for over a year now, and only half a dozen weeks with inflows in between. A little bit of a surprise, though, this week was the non-domestic side with about $962 million in outflows. Now, that's partially explained by two groups here. Emerging market funds had outflows about $643 million, although year-to-date they're still on the plus side. And European region funds, which had inflows about $31 million. So between those two, there simply wasn't enough interest in Europe to keep investors tuned to the non-domestic side of the equation. One of the best places this week was managed futures funds. They saw inflows of nearly $200 million. And I suspect, again, it's advisors preparing their customers for the volatility that we had 2 weeks ago. Well, let's turn our attention now to equity ETFs. If you thought that outflows were bad for the mutual fund side, ETFs suffered $13.6 billion in outflows, primarily through the SPDR, SPY. It was generally a risk-off week. We saw short bias equity ETFs with about $649 million in inflows, but light inflows after that. The real story, of course, SPDR Utility taking in about 228, or the VIX with 115. That was the best news for ETFs this week. The real story, though, again, it was SPY with outflows of over $10 billion. QQQ had outflows of over $700 million. And interestingly enough, the iShares UK product also had outflows, nearly $500 million pulled from them this week, an unusually high number. Well, let's turn our attention now to taxable mutual funds. They did not see the inflows that I might have expected. Everyone seems to be a Fed watcher these days, and no one's willing to commit new money to taxable bond funds. We've had 2 good weeks of performance, but with not much to show for it in the way of flows activity. We didn't find any taxable fund classifications with inflows of $100 million or more this week. It was all in the red. High yield funds suffered outflows of $160 million. Loan funds also had outflows, call it 115 this week. And short-term treasury products were actually the worst place, $262 million pulled from them. Again, a lot of concern about what the Fed will do next. Keep that thought in mind, though, as we turn to our next subject, the taxable fixed income ETF. They had inflows this week, $4.6 billion. Call that $4.6 billion in. They've had 2 weeks now in a row of $4 billion plus added to them. So definitely ETF investors find something favorable in the fixed income market that mutual fund investors do not. All but 2 categories on the fixed income side had inflows when we're talking about bond ETFs. And that was the Core Plus and the Loan Group. They didn't have much to show this week. Treasury was hot. We saw the SHY and TLT products lead the inflows parade. Light outflows elsewhere, as you saw on that previous page. There weren't too many places where investors were pulling money out of bond ETFs. So it's all systems go on that side. They're definitely seeing something that the mutual fund investors do not. Next group to take a look at, municipal debt funds. As I said at the top of the program, suffered outflows this week, about $125 million. They're fighting their way back into positive territory, but it might be a while. It seems like it's in doubt right now whether they can get enough investors behind them as they did earlier this year. We saw positive performance in 5 of the past 7 weeks, and if investors can't get behind that, I don't know how they can. We saw high yield muni funds, which has been one of the better performers this year and also one of the biggest gainers in terms of net inflows, only take in about $9 million, not billion, but million with an M, which is a very light figure, almost zero in my mind. On the other side, we saw a short maturity with outflows this week, as no one seemed to be all that interested in municipal debt funds. So taking a wait-and-see attitude is probably the best way to characterize flows to municipal debt funds these days. Last group to take a look at is money market funds. Again, $11.8 billion in outflows. Really two different groups at play here. Retail investors adding over $400 million to them, while institutions subtracted $12.2 billion. I suspect a lot of that found its way into taxable ETFs. So maybe that's where the institutions are looking after buying on the dip. Well, that'll wrap it up for this week's flows activity. Join us next week where another analyst will dissect the flows into mutual funds and ETFs. Of course, join us online at any time at lipperusfundflows.com. Thanks for watching.